Today we're going to talk about Chapter 4. Chapter 4 is completing the accounting cycle. So this is going to lead us through to the end of the year for the business's accounting. Chapter 4 has a total of 7 objectives, but we are only going to focus on the first 6. And a couple of them are actually a review from the previous chapters. So we'll start out first with Objective 1, describe the flow of accounting information from the unadjusted trial balance into the adjusted trial balance and the financial statements. This objective is actually going to review the flow of accounting information. It provides an opportunity to review the materials that's discussed in chapters 1 through 3, and it explains that many of the 10 steps in the accounting cycle, and the entire accounting cycle is presented in, I think, Objective 4 of this chapter. But a lot of the accounting cycle we've already been through in the first 3 chapters. Okay, so Exhibit 1 is actually going to show you the relationship between the end of period worksheet, which is discussed in the appendix to this chapter, and the financial statements. So this is what we're looking at with Objective 1. This is what we have finished so far in Objectives 1 through 3. In chapters 1 through 3, I'm sorry. We have our unadjusted trial balance, which was at the end of chapter 2. We have our adjustments that we learned in chapter 3, our adjusting entries. And then we end up with a new adjusted trial balance. Okay, so we will use this information from this worksheet to be able to prepare our financial statements. So if you look first, like we said in chapter 1, the first statement that we must complete is our income statement. And the income statement will come right off of the adjusted trial balance or also the income statement columns of the worksheet. So we always start out with fees earned, and then we go through our expenses, and we end up with a net income for the time period. Then once we have our income statement complete, we can then use that information to complete our retained earnings statement. And retained earnings statement always starts out with the beginning balance, which for Net Solutions, since we were a brand new company, we start out with a 0 balance. Okay, if we were starting our second year, we would be able to get our beginning retained earnings balance off of our adjusted trial balance as well. So then we net income and our dividends, and we end up with our ending retained earnings balance, which is then used again in our balance sheet. And that information for the balance sheet right off our adjusted trial balance. This is the end of period worksheet. There's columns across the top of the worksheet. Again, more information is presented in the appendix to this chapter. I would recommend that you read and review that information, but this is just a very brief overview of a worksheet. We start out with our accounts listed in order based on our chart of accounts. Then we have our unadjusted trial balance, which comes directly off of our general ledger. Then we have our adjustments columns. 2 possibilities. We have our deferrals and our accruals. Again, accruals, I'm sorry, this is chapter 3 that we just completed. And then we end up combining the 2 columns, our unadjusted and our adjustments, to come up with an adjusted trial balance. And we do this line by line. Then our revenues and expense balances from the adjusted trial balance column are extended into the income statement columns. And our assets, liabilities, and stockholders' equity balances from the adjusted trial balance column are extended into the balance sheet columns. And so we can use this worksheet. Essentially, we have already completed our income statement and our balance sheet on the worksheet. And then when we actually do the financial statements, we're just making it look nice and neat and pretty so that people can understand it. Objective 2 is prepare financial statements from the adjusted account balances. Objective 2 revisits the financial statements preparations that we introduced in Chapter 1. The balance sheet in this objective is expanded to include categories for current assets, property, plant, and equipment, current liabilities, and long-term liabilities. So it's a much larger, more well-organized balance sheet that's used by larger companies. Okay, so the income statement for Net Solutions is prepared directly from the income statement or the adjusted trial balance of the end of period worksheets. Okay, and we begin with any of our revenues, which in this case is fees earned. You can see this in Exhibit 2 in your textbook. And this is the completed income statement. We start out with revenues and we subtract our expenses, and in this case we end up with a net income because our revenue was larger than our expenses. And then this net income flows into our new retained earnings statement. And that's our retained earnings statement. Retained earnings statement is beginning plus net income less dividends gives us a new ending retained earnings balance. And that new ending retained earnings balance will go to our balance sheet. Okay, we again prepare this directly from the adjusted trial balance columns or the balance sheet columns. This is a new balance sheet for us because it has these new categories: current assets, property, plant, and equipment, current liabilities, and for Net Solutions, they have no long-term liabilities, so they're not listed there, and then our stockholders' equity. Okay, so we're going to look at each one of these classifications so that we can understand them a little bit better. Current assets are things like cash, accounts receivable, notes receivable, supplies. Okay, these are all things that can be used up within a year. Okay, usually the word current talks about the year. Okay, next, notes receivables are promises for our customer to pay that are in writing, and accounts receivable is usually just not in writing. That's the only difference between the two. We have our next is fixed assets called property, plant, and equipment. These are long-term assets like equipment, machinery, building, land. Current liabilities are these things that we are going to pay within 1 year. Accounts payable, wages payable, interest payable, unearned fees. Okay. Then we have long-term liabilities, and these are things that are not due for a long time, like outside of 1 year. Things like long-term note, mortgage, bond payable. Those things that have like a 10-year payback period. And then stockholders' equity is last, and that includes capital stock, retained earnings. Okay. Our objective 3 is preparing our closing entries, and this is the bulk of this chapter. This is where all of the new information is presented. So objective 3 is where you really want to focus your studying and your information. Okay, accounts that are relatively permanent from year to year are called permanent accounts or real accounts. These accounts carry forward from year to year, and a perfect example of a permanent or a real account is cash. The cash balance on December 31st is the same cash balance on January 1st. Okay, it's a permanent account that rolls over year to year. Okay, now the opposite of a permanent account is what we call a temporary account. Temporary accounts do not carry a balance, so that means at the end of each year we want to bring their balance back to a 0 so that we can start the new year accumulating information. So to report amounts for only 1 period, the temporary accounts have to have a 0 balance, and we do that by what we call closing them out. And we do this by the revenue and expense account balances are transferred to income summary at the end of the period. And then the balance of the income summary, whatever's left, which is always equal to net income or net loss from our financial statement, is transferred to the retained earnings. So we are taking essentially what the company has made or lost for this time period, and we're rolling it into our retained earnings account. And retained earnings is where we keep all of the information for the life of the business. How much money has the, how much income, not money, how much income has the company made over the lifetime of the business. And then last but not least, we take the balance of the dividends and we also transfer that into retained earnings. And so retained earnings is essentially the income or loss that the company has retained in the business. We can give it away to our shareholders by the form of dividends, or we can keep it. So retained earnings is what the company has kept in the company. And these are called closing entries. Okay. Step number 1, there's a 4-step system to the closing entry process. Okay, and this is exhibit 3 in your book. We start out by closing revenues into income summary, then we close expenses into income summary. We net the two, and we close income summary into retained earnings, and then we also close dividends into retained earnings. Income summary is an extremely temporary account. It is literally only open for 5 minutes. It's only open during the closing process. So we open it during, and by the end of the closing process, it will have a 0 balance. Okay, so here we go. Step one, of course, is to close the revenue account. Okay, so revenue accounts have a normal credit balance. We'll see here, this is their balance. So to close them, we debit them and we transfer it into income summary. So if we debit our revenue accounts, then we have to credit our income summary account. Step two is to close our expense accounts. We notice over here our expense accounts have normal debit balances. So to close them, we must credit them. And then we will debit income summary for the total. So when we add up all of these, it will equal $9,855. Step three is to close the balance in income summary. So when I net my revenue minus my expenses, I end up with a balance in income summary equal to $7,105. That's equal to my net income. So I will do whatever it takes to make income summary have a zero balance. So in this case, I have to debit it, so I will credit retained earnings. And then last but not least is to close my dividend account. Dividends down here has a normal $4,000 balance, debit balance. So to close it, I will credit. So then that means I have to debit retained earnings. Remember, my debits must always equal my credits. And this is what it looks like in general journal format. Okay, step one, step two, step three, step four. When we post this journal entry, we'll end up with all of these accounts except retained earnings having a zero balance because these are all temporary accounts except retained earnings. And this ledger proves it, shows you those. Okay, so these accounts are our permanent accounts that roll over from year to year. Okay, and then we get to our temporary accounts: dividends, zero balance; income summary, zero balance; rent, and all of my expenses have a zero balance to start the new year with. And then, last but not least, we create our post-closing trial balance. And this is just like any other trial balance that we have prepared at the end of Chapter 2 and the end of Chapter 3. This is just to prove that my debits equal my credits. And with the post-closing trial balance, the only thing that will be listed are my permanent accounts. So for Net Solutions, it'll look like this. Notice there is no revenue and no expenses and no dividends listed here because they have zero balances. So there's no point in listing them. All right, objective 4 is to describe the accounting cycle. There are 10 steps in the accounting cycle from the very beginning to the end, and it looks like this. Analyze transactions and record them in the journal. That's what we did in Chapter 2. Transactions are posted to the ledger. That was also Chapter 2. An adjusted trial balance is prepared. That was Chapter 2. Then we do adjustment data is assembled and analyzed. This was Chapter 3. An optional end-of-period worksheet is prepared. This was introduced in this chapter. We have adjusting entries are journalized and posted to the ledger. That was Chapter 3. An adjusted trial balance is prepared. That was Chapter 3. And then finally, financial statements are prepared. Chapter 4. Closing entries are journalized and posted to the ledger. Chapter 4. And 10, a post-closing trial balance is prepared. That was Chapter 4 as well. Objective 5 says illustrate the accounting cycle for one period, and this is literally what you need to look in your book because it takes you through the 10 steps for Net Solutions all the way from the beginning. So it goes through all the journal entries that we did in Chapter 2, the unadjusted, the worksheet, adjusting entries from Chapter 3, adjusted trial balance, our financial statements, closing entries, all of that. Okay, so it goes all the way through. So this is a really wonderful example of the steps. Objective 6, explain what is meant by the fiscal year and the natural year of a business. So we said that we do closing entries at the end of the year, and for each business, the end of the year can actually be different. It does not have to be December 31st. An annual accounting period adopted by a business is known as its fiscal year, and it can start and end on any date that they so choose. Usually they adopt what is considered their natural business year. So for retail businesses, their natural business year is usually ends on January 31st after the rush of Christmas. because January is